Imagine waking up, checking your brokerage account, and seeing your portfolio down 15% in a single day. You check the news. Did a war break out? Did a major bank collapse? No, nothing fundamentally changed about the companies you own. So what happened? You just became collateral damage in a liquidation cycle. It's a period of rapid, violent market deleveraging. It's not about what assets are worth anymore. It's about hedge funds, institutions, and retail traders being forced to sell everything they own just to survive. When leverage is high and the market drops even slightly, it triggers margin calls. To pay those margin calls, investors have to sell their best assets. That forced selling drives prices down further, triggering more margin calls for other people. It is a vicious, automated doom loop, and in today's market driven by high-frequency trading algorithms and massive institutional leverage, these cycles happen faster and hit harder than ever before. If you don't know how to spot a deleveraging event, your portfolio will get wiped out by someone else's bad debt. But if you do understand the mechanics, not only can you protect your hard-earned wealth, but you can also scoop up incredible high-quality assets at generational discounts. In this video, we are diving deep into the anatomy of a liquidation cycle. I'm going to show you the warning signs flashing in the market right now, how rapid deleveraging actually works behind the scenes, and most importantly, the exact portfolio defense strategies you need to survive it. Let's get into it. To understand the liquidation cycle, we first have to understand the fuel that powers it. Leverage. On Wall Street, leverage simply means using borrowed money to increase your potential return. In a bull market, leverage is a trader's best friend. But when the tide turns, it becomes a weapon of mass financial destruction. Here is exactly how the doom loop works. Let's say a massive hedge fund has billions of dollars, but they've borrowed billions more on margin to buy stocks. Suddenly, a bad inflation report drops, or the Federal Reserve raises rates unexpectedly. The market dips by, say, 5%. That 5% drop eats away at the hedge fund's collateral. Their broker calls them up. This is the infamous margin call, and says, "Your account value is dropping. Deposit more cash immediately, or we will sell your stocks for you." But what if the fund doesn't have the cash? They have to sell, and here is the crucial part. During a liquidation event, you don't sell what you want to sell. You sell what you can sell. Institutions start dumping their most liquid, highest quality assets like Apple, Microsoft, and even gold just to raise cash. This massive wave of selling drives the entire market down further. That triggers more margin calls for other funds, which causes more selling. The loop repeats until the leverage is completely flushed out of the system. So, how do you know if you are just in a normal market pullback, or if you are staring down the barrel of a rapid deleveraging event? You look for the warning signs. Here are the top 3 red flags. Warning sign number 1. Correlations go to 1. Normally, stocks and bonds move inversely. If stocks drop, bonds or gold usually go up as investors seek safety. But in a liquidation cycle, everything drops at exactly the same time. Stocks, bonds, crypto, precious metals, everything goes red because people are desperate for US dollars. If you see gold crashing at the exact same time as tech stocks, a liquidation event is likely underway. Warning sign number 2. A violent spike in the VIX, also known as the fear gauge. We aren't talking about a slow creep up to 20. We are talking about the VIX exploding past 30 or 40 in a matter of days. This indicates that institutions are panicking and aggressively buying put options to hedge their bleeding portfolios. Warning sign number 3. Stress in the financial plumbing. Keep an eye on credit spreads, the difference between the yield on corporate junk bonds and safe US treasuries. When credit spreads suddenly blow out, it means banks have stopped trusting each other and are refusing to lend. When the credit freezes, the forced selling begins. Once you see these 3 signs flashing, the deleveraging has already begun. The trap is set, but you don't have to get caught in it. It's time to play defense. Alright, the warning signs are flashing. The VIX is spiking. Correlations are going to 1, and the Wall Street doom loop has begun. The storm is officially here. How do you protect your money? It comes down to executing 3 critical defensive strategies. Strategy number 1. Delever and de-risk immediately. If you are trading on margin, cut it right now. In a liquidation cycle, your broker will not give you the benefit of the doubt. They will liquidate your account at the worst possible time. Next, you need to ruthlessly audit your portfolio. Look at your highly speculative, unprofitable companies, the ones that rely on cheap debt to survive. In a credit freeze, those companies are the first to be taken out to the woodshed. Sell the high beta, speculative junk before the big funds are forced to dump theirs. Strategy number 2. understand that cash is a position. I know we've all been taught that cash is trash because of inflation, but during a rapid deleveraging event, cash is king, specifically the US dollar. When institutions get margin called, they need us dollars to settle their debts. This creates a massive temporary surge in the value of cash. Having a cash fortress doesn't just protect you from the downside. It gives you the ultimate superpower when the dust settles, the ability to buy. Strategy number 3. Pivot to fortress balance sheets. If you are going to hold stocks through the storm and you should hold your long-term winners, make sure they are fortresses. You want companies with massive free cash flow, enormous cash reserves, and very little short-term debt. Think about companies that sell things people have to buy, regardless of what the stock market is doing. In a liquidity crisis, companies with debt get crushed. Companies with cash become the banks. Now, some of you might be thinking, should I short the market or buy put options? If you are an experienced trader, yes, buying protective puts on your portfolio can act like insurance. But a word of warning, during a liquidation cycle, volatility is so high that option premiums become incredibly expensive. For most retail investors, the best defense isn't a complex derivative strategy. It's simply holding cash, avoiding margin, and hiding out in quality. If you execute these 3 strategies, you won't just survive the crash. You will be standing on the sidelines with dry powder while everyone else is panicking. And that brings us to the most exciting part of a liquidation cycle, the aftermath. Baron Rothschild famously said, "The time to buy is when there's blood in the streets." But what he didn't say is that you have to make sure it isn't your blood. Because you played defense and protected your cash, you are now in the top 1% of investors who are ready to play offense. A liquidation cycle creates the greatest wealth-building opportunities in history. Why? Because forced selling creates irrational pricing. Remember, institutions aren't selling Apple or Microsoft because the companies are suddenly bankrupt. They are selling because they are legally forced to meet margin calls. That means you get to buy the best companies in the world at steep, irrational discounts. But how do you know when it's safe to buy? Rule number 1. Do not try to catch a falling knife. In a rapid deleveraging event, assets can fall much further than any valuation model says makes sense. Instead of trying to guess the exact bottom, wait for the all-clear signals. You are looking for 2 things. First, the VIX stops making new highs and begins to crush rapidly back down to normal levels. This means the panic buying of put options has ended. Second, and most importantly, look for the bailout. A true liquidation cycle usually only stops when the central bank, the Federal Reserve, steps in to inject liquidity into the system. The moment the Fed announces an emergency lending facility, rate cuts, or quantitative easing, the forced selling ends. That is your signal to deploy your cash. When that signal flashes, you don't buy speculative garbage. You buy the fortress companies we talked about earlier. You buy broad market ETFs. You dollar cost average into the blood. Because once the leverage is flushed out of the system, the rebound is almost always just as violent as the crash. Market crashes and deleveraging events are terrifying if you don't understand them. They feel like the end of the world, but now you know the mechanics, you know the warning signs, you know how the big funds get trapped, and you know how to build a fortress around your own wealth. A liquidation cycle is just a transfer of wealth from the over-leveraged to the well-prepared. Make sure you are on the right side of that equation. If this video helped you understand the market better, hit that like button. It helps push this financial education to others who might be over-leveraged right now. Subscribe to the channel so you don't miss our next deep dive into market mechanics, and let me know in the comments below, what is the number 1 fortress stock you are planning to buy during the next market crash? Stay safe out there, protect your capital, and I'll see you in the next video.